ETFs. Now, I haven't done one of these in a while. I rarely talk about ETFs anymore, and I don't really do my top 10 and top 5 lists anymore. I feel like they're a bit ridiculous and outdated, but you guys seem to like whenever I give you my personal favorite stocks and ETFs, so I thought I'd do another one. So I'm a stock picker. I don't hold any ETFs myself, sadly. Maybe one day I'll add one to my portfolio, but if I had to buy any, these are my 5 favorite ones. It's going to be a little bit of everything, so it's not going to be like 5 different S&P 500 ETFs or 5 different ARK Invest ETFs. No S&P 500. I like growth, I like risk, so these ones are going to be a bit riskier than the S&P 500. Now keep in mind, these are my personal favorites. It's not financial advice, and if you're not sure what an ETF is before I start, it's basically a basket of stocks collected into one, which you can trade, buy and sell just like shares of a regular company. So without further ado, let's get going. To absolutely no one's surprise, ARKK made the list. So this is the brainchild of Catherine D. Wood. It invests in fast-growing, disruptive companies in various sectors of the tech sector, like 3D printing, genomics, financial tech, streaming, autonomy, robotics, and so on. And some of the notable holdings are Tesla, Square, Illumina, Roku, CRISPR Therapeutics, Baidu, and Spotify. You might have heard of those. Now, it's actually a pretty large fund now, with more than $18 billion under management, thanks to a lot of recent inflows. It's a very, very popular fund now. It was one of the top performing funds in the world in 2020. And its returns and volatility have far outpaced the S&P 500, and it has had a 36% annual appreciation since the inception back in 2014, I believe. So for 6 years, 36% a year might sound outrageous, but that's what you get when you bet on innovation and disruption. So this fund is quality research over portfolio management. It's risk over value. It's ARK Invest. So despite its 0.75% expense ratio, the most expensive one on this list, this has to be my favorite ETF. But amongst the broad tech ETFs, this one has to be my favorite by far. It tracks the Nasdaq 100, so it holds all the big companies like Apple, Microsoft, Amazon, Facebook, Nvidia, Adobe, Tesla, Alphabet, and so on. Now, this is the cheapest Nasdaq 100 tracker, and it barely beats out the competition like Vanguard's VGT and iShares IGV, as I like the holdings a lot more than both of those. And although it's more expensive than VGT, it's cheaper than IGV. So I think it's a lot better than those two. Well, a little bit at least. Now, I know most people prefer the S&P 500, so the VOO or the SPY, because it's a more diversified index and it's more stable and it pays like a higher dividend. But I prefer the risk and growth of tech. And although people say, well, you can't have all your money in tech, you gotta spread out a little bit. Well, I think calling it the tech sector is a bit unfair at this point, since I believe tech has developed into all different categories, and it's not like in the 1990s or 2000s where every internet company was like a .com website. Tech companies are huge, they're everywhere, they're a part of every industry, not just the tech sector, right? So every company in every industry are customers of Amazon and Microsoft, Adobe, Alphabet, and so on. So calling it a sector, I don't think will do it anymore. Now, the return for this one has just about doubled the S&Ps over the last 10 years, and I expect it to continue the outperformance, albeit not at the same pace, as many of these companies have matured over the years, but I still see more upside, more risk than the S&P 500, although you have to pay more and you get less dividend. I think this is a better option. Now, exposure to Asia and in particular China, I think is a given for any investor at this point. And one of the best ways to play it is an ETF, because not all of us knows what's going on in China. We don't live there. Many of the companies are difficult to get your hands on, just the shares of the company. So I think an ETF is a good way to play it. You know, some of these companies have become so big and they have 1.3 billion customers in Asia alone, and then billions more in Southeast Asia. So these players, these companies can grow huge domestically and then go on to the world stage and compete with the Western companies. Now, this one will of course hold companies like Tencent, Alibaba, Meituan, Pinduoduo, JD.com and NetEase. Now, one of the few drawbacks of this fund is that it holds mostly large tech companies. And Chinese large tech companies are notoriously overlapping and quite similar. They all do e-commerce, they all do cashless payments, streaming, social media, video games, you know, AI stuff, self-driving, they all do it. So they are direct competitors to each other. And this is a tech ETF, so that's what you get. But it's not like in the West where Google has search, Facebook has social media, and Apple has hardware, and then Amazon has e-commerce. In China, everyone does everything. So that's a little bit of a drawback. But some of these players have become huge. As I said, they have 1.3 billion customers in China alone. That's more than the US and Europe combined. And it is still an emerging industry. And we can see them competing on the world stage now with Huawei, Neo and BYD, as well as Alibaba and Tencent. So they are really becoming global players. So it's no longer like a Chinese play per se. So I think exposure to China, Asia is a must. A lot of growth potential there. Sure, you have to pay 0.73%, but it's just as expensive as ARKK, and that's what you have to pay for the potential upside of this one, as well as access to some companies you can't invest in individually. So this is my Asia play and one of my top 5. Now to question of the day. This time it comes from InvestFi, so easy name to spell this time. So awesome work, man. Thanks for that. Keep up the hustle, yo. We love it. Oh, thanks so much here. What cryptos are you in? So I'm in Bitcoin and Chainlink. I bought Bitcoin in 2017, Chainlink in 18. They've both done really well. Made a lot of money, but they're purely speculative, and I'm probably going to go in and out of them a bit as prices go up or down. So it's not a high conviction sort of situation, more speculative. So I could go on and on with tech ETF after tech ETF. So I thought I'd give you something different. QBOTZ. So this has been one of my favorite ETFs for many years, and although its performance have been somewhat underwhelming, I'm not giving up on it yet, because I think the automation, improvement in efficiency and precision, and cost cutting of manufacturing and healthcare is a big trend. And the companies that are creating components, software, and sensors to back up this trend are in for a treat, as the race to replace humans with robots and AI really takes off. So some notable holdings are going to be Fanuc, ABB, Nvidia, Intuitive Surgical, Keyence, iRobot, AeroVironment, Yaskawa, and Mitsubishi. So mainly US and Japanese companies here, really high tech. Now, unsurprisingly, it's quite an expensive ETF at 0.65%, but again, that's why you have to pay up, and it is cheaper than its competition Robo. And I chose this one over Robo and ARKQ because I like the holdings more. It's a little bit cheaper, and you've got some of my favorite ones in there like ABB, Nvidia, AeroVironment, and Intuitive Surgical. But of course the other ones are pretty good. So this is a big trend. I think most people should be in it. I'm invested in Nvidia myself, and for this one I expect high volatility and high return than the S&P 500. So my fifth and final pick is going to be Global X's Catholic ETF. You know, I'm a sinner and I can't really help myself. Just joking. Can I joke about that? Is this okay? Do I have to delete the video? No. So we're ending with ARKF. So I had to go with another ARK ETF. And since I don't know anything about 3D printing, nothing about Israel stocks, and nothing about genomics, I had to go for this one. I think the move to e-commerce cashless payments and peer-to-peer economy and trading is a huge trend, especially internationally. And this ETF has more than 40% of its weight outside the US and the developed market, which is just exactly what you want to see in a fund like this. So it holds companies like PayPal, Square, Mercado Libre, Sea Limited, Tencent, and Zillow. So these will benefit from the rise of those things I mentioned. And you've got exposure to Asia and South America in there. And then US and Europe is covered by Square and PayPal. This is a huge trend you should be invested in. And some of these companies, again, you can't get your hands on shares outside of this ETF. And in some of those international markets, so South America, Africa, emerging Asia, and Eastern Europe, cash still makes up 90% of all payment volume, which means e-commerce hasn't really taken off either. So it's pretty much all up from there. And the companies that are standing to gain from this trend are in this ETF. So again, it's done really well. It has great volatility, pretty expensive, but that's nothing compared to the potential extra return you can make in this compared to something like the S&P. I'm really bashing on the S&P. I'm not. I'm just saying the potential return in these ones are higher. So, you know, I've been looking for a fintech play for so long, and I'm looking at Square, I guess. But if I can't decide, maybe I should just go with this one, or the Catholic ETF, of course. So that's my top 5 list. Give me yours. I know you guys know much more about ETFs than I do, and you're personally invested in some. So give me your picks. Give me your thoughts on my picks. Hope I'll see you in my next one. As always, take care, guys.